Imagine a company that sells $1 million worth of products in a single year. Sounds like a massive success, right? Now imagine that after every bill is paid, that same company keeps just $50,000. That is only 5 cents of profit for every dollar it sold. High sales do not automatically mean high profit. And if you only ever look at the sales number, you can be completely fooled about how healthy a business really is. In the next few minutes, I'm going to give you 4 key numbers that reveal the truth behind any business. Welcome back to Accounting with Professor Lamptey, where we make accounting simple. Today we are tackling profitability, how to tell whether a business is actually making good money. We will explore profitability through 4 key numbers, each building on the last. Profit margin and why sales is not the same as profit. Return on assets, including the sharper version the pros use. Return on equity, and finally the verdict, where we read return on assets and return on equity together. To keep everything concrete, we will follow one small business through the entire lesson. Let us call it Sunrise Supplies. Let us start with the most important profitability ratio, profit margin. Profit margin tells us how much of each sales dollar a business actually keeps as profit. Here are Sunrise's numbers for the year. The company brought in $200,000 in net sales. After paying for inventory, rent, wages, and every other expense, it was left with $20,000 in net income. The formula is simple. Profit margin equals net income divided by net sales. So that is $20,000 divided by $200,000, which gives us 10%. What does 10% mean? It means that for every $1 Sunrise sells, it keeps 10 cents as profit. The other 90 cents went to covering costs. A higher profit margin usually means the business is controlling its costs well. But a single number tells you very little on its own. 10% might be excellent in one industry and poor in another. So always compare profit margin to the company's own past years, to its competitors, and to the industry average. Now here's a mindset shift that separates beginners from sharp analysts. Sales and profit are not the same thing. Sales tell you how much customers paid the business. Profit tells you what is left after the business pays everyone else: suppliers, staff, landlords, lenders, and the tax authority. Remember our opening example, $1 million in sales, but only $50,000 kept. That is a 5% margin. One bad month or one supplier raising prices, and a thin margin like that can vanish completely. So when you size up any business, do not stop at the question, how much did it sell? The real question is, how much did it keep? So far, we have measured profit against sales. But there is another fair question. Is the business using its assets wisely? Assets are everything the business owns. Its cash, its inventory, its equipment, its buildings. The ratio that answers this is return on assets, or ROA. ROA measures how much profit a business generates from the assets it uses. The formula is net income divided by average total assets. Let us apply it to Sunrise. Its net income is $20,000, and its average total assets for the year are $200,000. $20,000 divided by $200,000 gives us an ROA of 10%. That means Sunrise earns 10 cents of profit for every $1 invested in its assets. Quick note on why we use average total assets. Profit is earned across the whole year, but the asset figure on a balance sheet is just a snapshot on one day. Assets go up and down during the year, so we take the average of the beginning and ending balances. A higher ROA usually means the company is using its assets more efficiently, but ROA varies enormously by industry. A bank might run around 1%, while an asset-light software company can run 15% or more. So only ever compare ROA between similar businesses. Now let us level up, because basic ROA has a hidden flaw. Look closely at the formula. Net income divided by average total assets. The problem is that net income has already had interest subtracted out, the interest the company paid to its lenders. But here is the catch. Those lenders helped pay for the assets in the first place. So basic ROA quietly punishes any company that uses debt to fund itself. The fix is called adjusted ROA. We add the interest expense back to net income, but after tax, because interest is tax deductible. Let us run Sunrise's numbers. Say the company paid $5,000 in interest during the year, and its tax rate is 20%. The after-tax cost of that interest is 5,000 times 1 minus 20%, which equals $4,000. We add that back to the $20,000 of net income to get an adjusted net income of $24,000. Now divide $24,000 by $200,000 of assets, and the ROA rises from 10% to 12%. That 12% shows what the assets truly earn from operations before financing decisions cloud the picture. This is the version professional analysts use when they want to compare companies fairly, no matter how much each one borrows. We have looked at profit against sales and profit against all the assets. Now let us look at profit from the owner's point of view. This is return on equity, or ROE. ROE measures how much profit a business generates for its owners on the money they actually put in. The formula is net income divided by average owner's equity. Here is where it gets interesting. Sunrise has $200,000 in total assets, but the owners did not pay for all of that themselves. Suppose they invested $100,000 of their own money and borrowed the other $100,000. So owner's equity is $100,000. ROE is $20,000 divided by $100,000. That is 20%. Look at what just happened. The exact same $20,000 of profit produced a 10% ROA, but a 20% ROE. The return to the owners is double. Why? Because the owners only had to put in half the money. Debt covered the rest. That is the power of leverage. But be careful. A sky-high ROE built on a mountain of debt is not automatically a good thing, because debt adds risk. That is exactly why smart analysts never look at ROE by itself. They read it alongside ROA, which brings us to the grand finale, putting ROA and ROE side by side. They sound almost identical, but they answer different questions. ROA asks, how efficiently is the business using everything it owns? ROE asks, what return are the owners actually getting on their money? The key is that total assets are funded by two sources, debt and equity. ROA looks at the whole pie. ROE looks only at the owner's slice. With Sunrise, the same $20,000 of profit gave us a 10% ROA and a 20% ROE. That gap, 10 versus 20, comes entirely from debt. Here is a clean rule to remember. The wider the gap between ROE and ROA, the more the company is relying on borrowed money. And if a business has no debt at all, ROA and ROE are exactly equal. So put it all together. Profit margin shows how much of each sale you keep. ROA shows how efficiently you use your assets. ROE shows the return to the owners. And the spread between ROA and ROE reveals how much leverage is at play. Never read just one, read them together. Let us quickly recap with Sunrise Supplies. Profit margin was 10%. Basic ROA was 10%. Adjusted ROA was 12%. The true operating return once we add back after-tax interest. And ROE was 20%, the return to the owners, lifted by leverage. 4 numbers, one company, telling a far richer story than any single figure could. If you remember one thing, never judge a business by one number alone. And if you want to see how profit margin, asset efficiency, and leverage combine into a single powerful formula, stay tuned. That is the DuPont formula, the perfect follow-up to this lesson. If this helped profitability finally click for you, follow Accounting with Professor Lamptey, where we make accounting simple, one lesson at a time. I will see you in the next one.